shares of Bank of America and Citigroup falling today, even after reporting earnings numbers that exceeded analysts' estimates. Investors worried by volatile markets, choosing to focus on the two firms' shrinking loan books. Joining me now via telephone to talk about the financial sector, Doug Ciocca, Managing Director at Renaissance Financial. Doug has about 17 years of experience in the field of investments and portfolio management. He's got small positions in both Citigroup and Bank of America. He joins us from Figure 8 Island. It's off the coast of Wilmington, North Carolina. Doug Ciocca, what do you make of the results? This seems to be all sort of positive, but based on the fact that the companies are setting aside less money to worry about all the people who can't pay their debts.
Yeah, I think that they identified very optimistically that they'd seen an increase in the decline in the deterioration of credit if that followed along. But I would characterize the quarters in general, Pimm, as very sloppy. I didn't see enough positive offset of the number of the decline of bad loans and the improvement in credit conditions that I could take to be anything meaningful as it relates to consistency or predictability of some of their sustainable profit growth. And if you look to see the offset of the decline in the number of bad loans, this didn't seem like there was much of an increase in loan demand.
So, Doug, what do you make of that when you combine it with the results for the trading operations? Weren't trading operations for big banks supposed to be the big money makers? I mean, that's what we've been talking about, borrowing money at very cheap rates from the Federal Reserve, from the government, and then turning around and trading it. Doesn't even seem to be working.
Well, I'll tell you, Pimm, banks has been forever known as leading indicators in the economy, and they are always what we would classify as interest rate sensitive stocks, right? A stimulative economic environment that would give way to a low cost of capital, which would then produce high net interest margins, as you mentioned. And these were known as very early cycle stocks. I think now in the post-credit bubble bursting of 2008, we've had to transition our outlook and analysis to look at these banks more as coincidence indicators. And given the new capital requirements, given high loan loss reserves, deflationary balance sheet conditions, these banks have become much more economically and not interest rate sensitive. And if you think about both BofA, Citi, and even JP Morgan, what they have now done is reflect sort of the general malaise of the overall economy.
Doug Ciocca, as someone who's an investor in these shares, what do you take away from a day where you can see Citigroup fall 9%, Bank of America fall 6%, and it was really just on, as you described it, sloppy earnings? There wasn't any outside event which made investors sell the stocks.
No, and I think we've known, Pimm, for a while that the banking business is going to be undergoing a shift in their emphasis from margin to more of a volume-based business model in the absence of the validation of excessive leverage. So there has to be a pronounced emphasis in that area. For BofA, it was the acquisition of Merrill Lynch that was going to give them increased distribution, a more stable revenue base with transaction and retail brokerage. For Citibank, it was going to have to be increased international exposure, as well as leveraging what remained of the 49% ownership of the Smith-Barney joint venture they now have with Morgan Stanley. It's a tough question because they now are towing a very tight rope and trying to satisfactorily serve Wall Street and Main Street. So what we take as investors is a great deal of caution, because I don't think, as Jamie Dimon put it very delicately yesterday, we don't consider declining loan loss reserves as earnings, nor should Citibank consider a deflated debt revaluation as EPS, nor should Bank of America consider the sale of China Construction Bank as a meaningful profit event. I want
to thank you very much, Doug Ciocca, coming to us from Renaissance Financial Management.